Hey everyone, this is Dimitri Pragmatic with MarketChameleon.com. One of the biggest benefits when you're trading options is that you could create different types of strategies or different combinations of trades based on your outlook in the stock. And one of the tools that you will need is a payout diagram at expiration to see if your strategy is fitting your outlook in that stock. And I'll give you an example here. I'm going to use just Intel in this example, and I went to the options chain here, and I went to this January 24th expiration. I do see that there's going to be an earnings January 23rd. So let's look for a couple different strategies, keeping in mind that there is an earnings coming up that straddles this expiration. The first thing, I'm just going to create a theoretical outlook, and let's just say I think that the stock is more likely to sit around the strike price. So I might want to do something like sell a straddle, and selling a straddle is selling a call. So here I clicked on the bid in the 59.5 call strike, which is the closest to expiration to the spot price, and I'm also going to sell a put. So you're selling a call and a put simultaneously on the same strike. That's a straddle. So you could see here the first thing that popped up after I clicked on them is selling the Jan 24th 59.5 call for $1.48 and selling the Jan 24th 24 59.5 put for $1.57. So I'm going to load this strategy to see what the diagram looks like at expiration. You could see here that if the stock stays in between these ranges where the green is, then this strategy will be profitable because we bring in $3.05 credit. This is the bid of the straddle, this is the offer, this is the midpoint, here are the Greeks over here, and we do see that if the stock goes beyond this amount, then we start losing, so at some point if the stock really moves and beyond the point where you collected premium, then you start losing over here in the red. That's to the upside, and to the downside, if it really moves, then you start losing over here beyond this point. So this is what a payout diagram looks like, so you could kind of visualize the range of prices where the strategy would be profitable given today's markets and where it will be unprofitable. So let's now start changing some of the assumptions, and let's assume that you're not super confident that if the stock moves that it's not going to move a lot. So maybe you're right here, the outlook is, I do think it's going to stick around here, but if it moves, then it's really going to move violently. So I want to protect my position beyond a certain point. So I'm going to go over here. We already have set up selling the straddle. So let's say I want to move down two strikes from 59.5 to 57.5, and I want to stop myself out to the downside. So I'm buying this put. So I see here 57.5 put. I'm going to click on the ask price. So it brought up buying the 57.5 put for 80 cents. And I'm going to do the same thing to the upside. So I'm going to start 59.5. Let's move up to 61.5. And then I'm going to buy this call, right, for 71 cents. So that's what happened. Buy Jan 24 call 61.5 for 70 cents. Let's rerun that strategy. So now it looks like a butterfly over here. So you see at some point, if we stopped out ourselves, so this is our max loss if it continues to go up, so it's not unlimited anymore. We still make money if the stock just sits here in the middle. This is at our highest point where we bring in $1.55 credit for this butterfly. Here's the market and the midpoint, 155, 161.5, midpoint 155. Same thing we could visualize on the downside. If it breaks this price and keeps going, at some point this is $45. That's our max loss to the downside. So if it continues, we stopped ourselves out to the downside as well. Now that we have it, we could also play around maybe with the strikes. Let's say this is the right strategy we want, but maybe we're a little bit more bullish and we think that the stock is more likely to drift up a little bit. So over here, we see here are all the strikes. So I'm going to just click on here and I'm going to raise all these strikes up one, or let's raise it up 2 clicks, right? So we raise it up by 1 strike, and then I'm going to reload that strategy. So you could see here this butterfly now shifted to the upside. So this line here is where it currently is. So now our max gain is up here if the stock goes up to 60.5 from its current price. And we could do the same thing to this downside. Let's say that our outlook's a little bit bearish. We like the strategy, but we think it's going to drift a little bit lower. So we're going to take a look. I'm going to lower it here by 2 strikes. Let's reload it. So here you see now we shifted this strategy down a little bit. We see we collected $1.57 credit. This is the bid and offer of this butterfly. This is the midpoint. And what we're doing now is just kind of tweaking the strategy based on our outlook, to make sure that it is the strategy fitting our outlook. If this is where we think the stock is most likely going to land at expiration, and then we could compare what our potential reward is versus our losses to make sure that this is an acceptable risk-reward ratio. Now let's do this. Since there's an earnings coming up, I'm going to flip this around and let's see what this looks like. Since there is an earnings coming up, I'm going to change my outlook and say, what if I bought this straddle, right? So I'm going to buy this straddle because I know that earnings is coming up, and my outlook might be that the implied volatility is more likely to go up as we get closer to earnings. So I'm buying this straddle, and so this is what it would look like, right? So if this stock sits here at expiration, obviously we're going to lose all this premium. But if it moves beyond this point, we start making money to the upside here and to the downside here. Now, this kind of looks very wide, so maybe what we want to do is the same thing, bring some premium in. So let's just do the opposite of what we did before and sell the wings this time. So I'm starting at 59.5. Let's go to 57.5. So I'm going to sell this put. So this way it reduces my cost of this strategy because I'm bringing in premium now. And I'm going to do the same thing with the call. I'm going to go to the 61.5 call. I'm going to sell this call, bring in 70 cents. So you could see here, I'm buying the straddle, 59.5, buying the call, 59.5, buying the put, 59.5. Then I'm selling the wings. I'm selling the 57.5 put, selling the 61.5 put. So let's rerun it. So now here we have a debit of $1.61. It's going to cost us $1.61. So it now, you see, doesn't have to move as much before we start making money to the downside or to the upside. If it sits here at expiration, we lose between these points. And let me one more time change my assumption, and let's say that I don't intend to hold this to expiration. I just want to hold it right up to earnings because I think that today's implied volatility is a little bit low, and I think the implied volatility is really going to explode. So earnings right now are on January 23rd. This expires January 24th. And let's say that, let me just make sure. So earnings are January 23rd after the market close. And I'm going to assume this, that right up to the earnings, there's going to be a flurry of buying, and the implied volatility is just going to explode, and it's going to go from current levels of 38, and I think it's going to go to 54. So I'm going to raise all these up to 54. Oh, let's say around 55, right? That the money 55, and I intend to get out. So let's reload this strategy now at 55, and I intend to get out of this on January 23rd. So I don't intend to keep it till expiration. I want to just unload it on January 23rd. So here's what this blue line's telling us, that if the stock still sits here, we're not going to lose as much, but still with the decay, with 1 day to go, it's not going to be profitable, even if the implied volatility increases to 55. We see if it just sits here, we're still at a loss. If it moves out here, then it'll be a gain. So let's increase it by more. To what level does it have to increase for this strategy to be profitable if we just got out of it right before the earnings, right? So we got out of it, if we're getting out of this January 23rd before the market closes. So let's increase it. Let's see what happens if we increase it. We double it. Let's go to 70 volatility. I'm going to reload that, and let's say the volatility goes to 70 on January 23rd. We're out. So even here, it's not quite enough. So this is a couple ways that you could look at it to see, to change the parameters in your variables, and take a look at the payout diagram to paint yourself a scenario where this strategy will be profitable, where the strategy will not be profitable, and does it fit your outlook, and is the risk reward, is it within your tolerance level. Hopefully this was very helpful to you guys, and see you guys in the next video. Bye.